It's been a tumultuous time on global oil markets. Just in July, oil fell 12%, and into next month, we'll see how it goes. But certainly, oil markets have been very, very volatile. It's a double-edged sword, of course. What is the reason behind the drop in oil? Well, let's find out from Dr. Jeremy Wakeford. He's a macroeconomist at Quantum Global Research Lab about what the Persian Gulf countries' boost to oil production, we're talking about Iran, of course, could mean for the embattled commodity. Jeremy, explain to me, please, what is going on in this oil market, because there seem to be a number of factors at play. We've got Greece falling on its face, Chinese markets collapsing, and the Iranians thinking it's a good time to start pumping more oil.
Yes, Bruce. Well, as you say, there are many factors that are impinging on the markets at the moment. We've got a number of factors on the supply side and the demand side, which are rattling investors and sending oil prices gyrating. And certainly on the supply side, the recent decision by OPEC to maintain its oil production quotas at around 30 million barrels a day is certainly supporting a drop in oil prices. And with the negotiations continuing with Iran and many hoping that there will be a deal done with Iran, with the Western powers, in order to alleviate the sanctions and allow them to increase oil production. The Iranians are saying that they'd like to perhaps even double the level of their oil exports, which would bring anything between, say, 500,000 and 1 million barrels per day of new supply or old supply back onto the markets. And that would certainly increase the glut that is temporarily in the oil markets at the moment, which many analysts are saying is running at about 2 million barrels a day.
What is the relationship between Iran and OPEC? Because if OPEC is sticking to 30 million and then the Iranians bring more in, is that part of the OPEC quota? Will that go on top?
Well, that would have to be negotiated within OPEC. At the moment, they have an organization-wide quota of, as I said, 30 million barrels a day. And obviously, there are very different interests within OPEC. We've got some of the other members hoping for lower production by the cartels, such as Venezuela, Nigeria, countries that are actually struggling to balance their budgets now with the oil price having fallen so much. And traditionally, Saudi Arabia has been the kingmaker there and the swing producer. And they've been adamant over the last 6 months that they're not going to let oil prices increase by cutting production. They're intent on maintaining their market share and perhaps putting extra pressure on the US shale oil drillers. And so there have going to be really tough negotiations within OPEC itself if Iran is going to be able to increase its supply that much.
One looks at OPEC and one wonders what's in it for OPEC in the short term anyway. Is it all about playing the 5-day test versus the American shale oil producers, or is there some other dynamic going on within OPEC itself?
Well, it's hard to say exactly what the political conditions and relationships between all the countries is, but obviously there's long history of geopolitical tensions between some of the members of OPEC, particularly Saudi Arabia on the one hand and Iran on the other. And, it relates to religious regions, the differences between the Shiites and the Sunni Muslims. But that's certainly not my area of expertise. Other people look at it from more of an economic point of view and just say that at the moment, in the current oil environment, all the producers simply want to maximize revenues, and in order to do so, they have to maintain their production levels because with 2 million barrels a day of spare capacity, even Saudi Arabia now would probably have little impact on the global oil price if it cut production by, say, 1 million barrels a day. So they'd rather just keep producing their 10 million barrels a day and earn what revenues they can.
Jeremy, you made reference earlier to a temporary glut in the oil market, implying that you don't believe this pullback towards about $55 a barrel as it is around now is sustainable.
Yes, well, I'm thinking in terms of a number of years. I mean, we certainly could see the price as low as this or even lower over the next 6, 12 months, even perhaps a few more years. But there are a number of longer term factors which indicate that oil markets will tighten up again. For example, the International Energy Agency and the US Energy Information Administration have both said that they expect US tight oil production to plateau from around 2020. Other independent researchers have suggested it'd be even before that tight oil production will start to decline from next year, the year after. Then we've got revisions to the supply outlook for countries like Brazil and Iraq, which are much less optimistic than they were a couple of years ago, partly because of lack of investment. In Iraq's case, it's the ongoing political conflict, the civil war, if you like, with the ISIL. And so there are definitely supply risks in the sort of medium to longer term.
We've got an American economy which seems to be recovering quite nicely. We've got a Greek economy which is in all kinds of trouble, at risk perhaps of destabilizing in the short term. Anyway, any kind of sort of unity within the European Union. And on the other side of the world, we've got a market rout happening in China. These factors in the global nature of oil?
Yeah, definitely. Well, these are the demand side factors that are also weighing on the equation. And from the demand point of view, it's really, there's not much bullish news. These factors you mentioned are all supporting the drop in the oil price. The Chinese economy is really at, I would say, considerable risk. Their stock market is now off about 30% since the middle of June, but that's after nearly doubling over the past year. So they really did create something of a bubble there. There are very big concerns around their property market and how sustainable it is. And to me, this is some of the chickens coming home to roost over the last few years, where they've been pumping enormous amounts of money into the economy in order to try and creep the growth rates at these 7.5 and plus percentage points. And in the global environment with weak demand for Chinese exports, a lot of that money has been channeled into speculative activities in the real estate market. And then with the Greek situation, certainly if there's a wider financial crisis within the Eurozone, that would tend to reduce Eurozone economic growth and therefore demand for oil.
What about the Americans? The Americans have been very proud of the fact that they've been practically energy self-sufficient for some time, courtesy of fracking and courtesy of their ability to produce their own energy at home, and it's helped their trade deficits considerably. If it becomes sub-economic for many of the producers to keep producing, what happens to America?
Yes, well, firstly, Bruce, there's been quite a lot of hype, extremely amount of hype about the tight or shale oil revolution, as it's been called in the US. And whilst the production levels have increased dramatically over the last few years, from about 5 million barrels a day to over 9 million barrels a day now, compared to about 5 years ago, it's not quite as simple as that. There have been a number of analysts showing that, in fact, the cash flow for the tight oil industry in the US has been negative, even when oil prices were around $100 a barrel. A lot of money has been poured into that. Some people say it's been something of the next Wall Street bubble after the housing bubble that deflated a few years ago. So the production, although it has ramped up, we've seen a very steep decline in the rate of drilling in the United States. It's down by about 60% over the past year. And this implies that within probably 6 to 12 months, might see some decline in the rate of production from tight oil. And it's by no means true that the US is oil sufficient, self-sufficient. It's still importing at least a third of its, or close to half of its oil supplies.
Okay, but it runs the risk, does it not, if that recovery continues apace as it seems to be doing, and if we do see a drop-off in drilling and we do see a drop-off in local manufacturing of energy and petroleum products, that they'll have to up their imports, and that changes the dynamic a year or two from now. Give me your very best estimate as to what's likely to happen in this oil market in dollar terms in the next 12 months. It's a bit like trying to forecast the rand, I understand, but just give me a sense of your best estimate as to what's going to happen in this oil market.
Okay, well, I'll put my head on the block a bit. I don't normally like to try and forecast oil prices. As you say, it's one of the hardest things to do. But to me, it seems like the weight of factors is really against a recovery in oil prices within the next few months. There are too many big risk factors for it. We could probably see even a slight decline in the oil price. Out into next year, I would probably say it would keep in more or less a similar kind of range to what we've seen over this year. But later on in that, from maybe the middle of next year, it's quite possible that we'll start to see somewhat of a recovery in oil prices. And that's with the proviso that there hasn't been a major financial problem resulting from the Greek situation or the Chinese stock market for that matter.
My thanks to Dr. Jeremy Wakeford. He's on the line to us from Geneva this evening. Thank you, Jeremy, very much for joining us. He's a macroeconomist at Quantum Global Research Lab. And also, just looking at the level of the oil price at around $55 a barrel, that's incredibly welcome for South African consumers. The only problem is, on the flip side of that very attractive and shiny coin, we've got the rand and its fall to about 12.50 to the US dollar. So what you win on the swings, you lose on the roundabouts. If we can see some rand strength, when we might see petrol price cuts and see another mini economic boost as we did between August and about February this year, while the oil price was quite depressed and the rand was less dreadful than it has been in recent weeks. So we hold thumbs and we hope for that perspective to come through, unless you're a Sasol shareholder, of course, in which case Dr. Jeremy Wakeford makes you incredibly grumpy with his forecast of low oil for longer. Thank you to you for your company this evening. Thank you for watching. There'll be more tonight, tomorrow. Till then, bye-bye. Thank you, Jeremy.